Good morning and welcome to the Monday Call brought to you by NZ Funds. I'm Stefan Clark, Chief Client Officer, and in the studio with me is Mark Brooks, Chief Investment Officer. Today we're joined by top economist Cameron Bagrie, former ANZ Chief Economist, and today leader of Bagrie Economics. The New Zealand economy is turning a corner, with green shoots replacing red flags and confidence inching its way back. But global uncertainty remains. Trade tensions are heating up and tariffs loom large. Will the recovery move up a gear, or are the brakes about to be applied? Will our exports be hurt? Can we create new markets? And how should investors think about both risks and rewards in this shifting landscape? Cameron, it's awesome to have you back on the show. Welcome from Wellington.
Nice to have you.
Let's kick off with New Zealand. The outlook locally, where do you see the biggest opportunities and the biggest risks for our country?
Well, I guess you've got to break down opportunities into a different time frame. So if you're looking in the near term, the next 12 to 18 months, it's pretty obvious that monetary policy, i.e. lower interest rates, is going to do a lot of the heavy lifting. You're getting the economy back in forward propulsion, and we do have forward propulsion now. It's not fast forward propulsion. I characterise New Zealand as we're out of reverse, we're in first gear. That's a positive, but it's a pretty frustrating speed to be going along the motorway. You've got to get up towards third, fourth or fifth. But the Reserve Bank taking interest rates down is going to stimulate the obvious sectors, all your interest-sensitive sectors, construction, retailing. That's the second half of 2025 story, but the ball is moving to play. The longer term story about New Zealand is, I think, a little bit more interesting. Is where's New Zealand going to be 5 to 10 years out? And I guess there's two sides to that equation. Number one is the glass half empty. Productivity growth has averaged for the past decade 0.2% per year, which is basically zero. So living standards are not on the improve. If living standards are not really on the improve, you've got a pretty big economic incentive for people to bugger off overseas, which is what we're seeing. So we need to get productivity back on track. And that's at the epicenter of driving earnings, profitability, along with living standards. So the good news story out of New Zealand is that we're sitting on a bit of a winning lottery ticket when you think about our natural resource base. And this is renewables, this is water, this is potential to store water, irrigation, unlocking more primary sector production, big economic exclusive zone. Yes, we don't want coal, but there's other minerals that we've got plenty of around the country. Security is now a big theme globally. It's security in food, energy and technology. And guess what? New Zealand produces food. And we need to work out how we're going to leverage into that security overlay as a theme. So we've got a lot of upside if we can get our house in order. The big uncertainty or the big risk globally is the world is fragmenting. We're shifting into trading blocks. It sort of resembles, I think, the 1920s. And the 1920s, of course, morphed into the 1930s, which was not exactly a happy playground in regard to what went on. But there's a lot of trade tension, and we're seeing the rules-based system we've been used to in regard to trading is now being usurped by countries exercising power. And that's a pretty dangerous environment to be when you're a small open trading country such as New Zealand that doesn't have a lot of power.
In the shorter term, do you sort of get the sense that that agricultural side is more buoyant and more positive about the outlook? And in terms of that's, I suppose the speed on the motorway.
So it's interesting, liaising with the farmers because they're never the most happiest group out there. Currency goes down to 50, 55, 56 cents, and they're all worried about the fertiliser bill. Whereas you've got to have a look at the income line, and the income line's through the roof. So if you look at the ANZ Commodity Price Index, both the red meat and the dairy index in New Zealand dollar terms have hit all-time highs. Now, we all know that cost structures across the rural sector, dairy, red meat, horticulture have been absolutely thrashed over the past 5 to 6 years. So what we saw between 2018 and about 2022, 23 was that cost structures, depending on the industry, were up about 30 to 40%. And the income lines didn't move a lot. So we were seeing a lot more red. If you ever look at where commodity prices are today, and the example is dairy prices, your dairy prices are 90% above where they were in 2018. Red meat prices are around 70% above where they were in 2018. So we've had a bit of an inflection point in the past 12 months where your price growth coming from the income line is now exceeding the increase in cost we've seen since 2018. So that there is a bit of positivity that's starting to come back into the sector because they're starting to see a little bit of cash flow return. So we're going to see a little bit more investment. Mind you, the banks want the money back, so they're going to get them to pay down debt as well. And longer term, the sector still needs to face up to environmental responsibilities. But if you want an illustration of where New Zealand needs to go, the government's talking about doubling exports, which basically you need to take exports to 100 from 100 billion to 200. You're not going to do that by trade agreements alone. You've got to produce the stuff, right? And the big issue here in New Zealand is that where is that production going to come from? How are we going to physically double exports? Some of that will come through price appreciation, but a lot of it's going to come through volume as well. And at the moment, we've got an external trade plan, and we've been doing some pretty good stuff, talking to new markets. You're trying to penetrate more existing markets such as Japan, but we need to turn the focus on the supply side because exports as a share of GDP have gone from 30% to 24%. And that's one of the reasons our current account is still up in excess of 6% of GDP. So if you go back to about 2011, 2012, Bill English and Stephen Joyce had an aspiration where we're going to turbocharge exports. We're going to take them to 41% of GDP. Sorry, to 40% of GDP. We're at 30. We got to 31. And it's been, in the last 5 years, we've lost about 6 percentage points overall. Now some of that is tourism, because tourism's running about 84% of where it was pre-COVID. But a lot of it's just come through the private sector. Destocking, peak cow, that sort of stuff.
I guess, shifts are always going to happen. Do you see it reversing and starting to go the other way again?
Well, we're starting to see some good stuff take place. Look, number one is that the New Zealand dollar has started to play ball. One of the reasons our export sector got beaten up was that we had a very long extended period where the New Zealand dollar was in excess of 70 cents. That was a relative price signal that favoured importing over exporting. And when the New Zealand dollar was around 60, 63, and we wobbled around there for about 12 months, the bias was it was going back to 65 to 70. The current account did not validate it going back to 65 to 70. And now all of a sudden people start to think the combination of the US Federal Reserve having a bit of a sticky inflation problem, the current account deficit, you need that New Zealand dollar in an export-friendly zone, not just for 12 months, we need it there for 5 years.
Okay, and so consumers locally, how are they going? How is business, consumer confidence going, and is that translating to business confidence more broadly outside of the primary sector?
Well, it's interesting. If you look at the two sides of the economy, your business confidence is off to the races. And some of that is a natural statistical bias where businesses tend to be more confident under a blue hui as opposed to a red hui. So we tend to discount business confidence as an economic indicator and tend to focus on firms' own activity expectations, investment intentions, employment. And those numbers are above average. Now, part of the reason they're above average is because we're coming out of an economic hole, so it's a little bit easier to look up. So they're a bit biased at this juncture of the cycle, but they are saying that businesses are looking ahead to the next 12 months and they're expecting better times. And we're starting to see the early stages of that. If we look at the other side of the economy, which is consumers, those people that buy the stuff, consumer confidence is still pretty low. It's not viewed as a positive time to go out there and buy a big household item. There's still a fair bit of financial pressure that's coming through. Inflation's come down, but some components of inflation, such as insurance, energy charges, local authority rates, are still pretty elevated. And there's a big problem across New Zealand in regard to wealth, income inequality, that the food banks have never been busier. So at face value, we've turned the corner, but there's still some real pockets of weakness out there and pressure, and retailing's a tough gig.
To put it another way, does that sort of suggest, given the length of high interest rates, given the length of the sort of recession or thereabouts, that actually there's sort of a balance sheet rebuild that most consumers need to go through before they can really start spending?
Bit of a balance sheet rebuild. I think there's a little bit more conservatism that's starting to come through. The unemployment rate is moving up. It doesn't look like it's peaked. So people are just wanting a little bit more of a buffer just for that that uncertainty aspect in regard to what's going on. The good news for retailing is that the effective mortgage rate is coming down pretty quickly as the Reserve Bank cuts interest rates. And around 70% of mortgages are going to refinance in the coming 12 months. Borrowers in aggregate have actually played this borrowing cycle pretty well. In 2023 and 2024, when the Reserve Bank's cutting rates, everybody's shortening up the duration of their borrowing. If a 3-year rate rolled off, you took a 6-month, right? Because you wanted those rates to be a bit lower before you chipped in with a 1 or a 2-year rate. So we're starting to see that benefit of lower interest rates is going to proliferate through the general economy pretty quickly in 2025. And the hope is we start to see a little bit more life out of some of those interest rate sensitive sectors second half of the year.
Yeah, it was interesting just anecdotally here, sort of being in central Auckland, that you did feel like retail over Christmas and certainly hospitality had more of a spark to it, much more than it had in a long time. And maybe that was just at the margin, that change in disposable income. It'll certainly take a lot longer for big ticket items, but just at the margin, it felt much more buoyant.
Well, there's a couple of interesting things that have gone on. Well, number one, I think we got a little bit divorced from economic reality, because 2021 and 2022, it was party time. The government's pumping 50, 60 billion bucks into the economy over a 3 to 4 year period. Interest rates are basically at zero. The Reserve Bank's got the printing press up. Your house prices are off to the rodeo. We couldn't travel overseas for periods of it, so the international travel money got diverted into buying a new car and a big ticket item. Now, as soon as borders opened, well, guess what? We're travelling again. So a lot of that money that was being spent locally in 2021 and 2022 found itself into overseas tourist hotspot pockets. And that's just been a normalisation process. I spoke to a car dealer 18 months ago, and he said, "What do you think the budget should be for the next 12 months?" I said, minus 15 to minus 20. He said, "I was thinking plus 10. I said, "Good luck. You're up about 30 in the past 2 years." Well, you got to have some leakage, because people are not going to replace the car. They're going to holiday in Europe because we haven't been able to.
Yeah, definitely.
I guess with durable goods like that, people buy it when they've got the cash, and then they run them down for the next 10, 15 years as they redeploy their money elsewhere.
Yeah, so people at the moment, well, the car dealers are not happy because they're not selling a lot of stock, but they're pretty busy in the workshop because people are holding on to the car for an additional 1 to 2 years. So you just need to do the required maintenance. Yeah, so what you lose on one side, you pick up on the other side of the business. So same with farmers and tractors. They push the replacement cycle for the tractor out a year or two, but you can't push that stuff out too long.
Okay, so if we get the recovery right, in inverted commas, and rates do drive things forward, where do you see the economy going in the medium term, sort of 3 to 5 years? Are you worried about it, or are you confident that it's going to just truck on and keep grinding as primary industries produce?
Well, it's not just primary industries. It's we're getting effectively a steroid shot in the arm from monetary policy. Right, so growth in 2025 and 2026 is going to be a lot better than what we've experienced in the past 18 months. We're going to get growth. Right, that's low down this year. The issue is the quality of that growth and durability of the economic cycle. And that comes down to what's called the supply side of the economy. That's a combination of labour, capital inputs, how efficient we are at utilising those resources. That defines how fast you can grow without hitting capacity constraints and inflation pressures and the Reserve Bank having to hit you on the head by lifting interest rates again. And both the Reserve Bank and Treasury have been revising down over the past few years what's called productivity growth, the trend. And the Reserve Bank is now saying potential growth is 1.5 to 2% per year. So at the moment, it looks like we've got a negative output gap, i.e. capacity gap of about 1 to 1.5 percentage points. So that means, let's say it's 1.5. So we can probably grow in excess of capacity, i.e. 0.75 percentage points for the next 2 years. So 1.5 to 2, 1.75 midpoint, we can probably have 2 years of 2.5% growth before we hit capacity constraints. Now, 2.5% is okay. Normally you go through an upthink swage, you pencil in a 4% plus number easily. So we're going to get still constrained by the productivity story on the outside. And this is where the roading network, education, the quality of New Zealand's infrastructure, management practices with AI, technological update, digitalisation, that sort of stuff. We need to be a lot firmer and stronger in those areas, and we're just not.
Okay. Well, I mean, what would you do if you were holding if you were in control of it and steering the rudder?
Well, one of the good news things about New Zealand at the moment is that quality is counted. You have a look at what we're seeing within the retail sector, and you look at, there's the obvious ones. You look at Rod Jerk and Briscoe's versus the Warehouse. Right? You have a look at what we've seen within the building sector. You have a look at the success of Fonterra, turning that business around. It hasn't been flash airy stuff, it's just been an awful lot of hard work. You look at the red meat sector in regard to some people are still making money, and there's some others, cooperatives that have lost a bucket load of cash. So this is a market where quality, not just in regard to the business, but your governance, your management really count. New Zealand is still that old school sort of market where we like to pay dividends as opposed to hold on to people's money and give it back to you in the form of value add. But the underperformance of the New Zealand market in the past 2 to 3 years has been absolutely phenomenal compared to global peers. And even if you strip out the Mag 7 and all those other lovely little catchphrases that we have, but New Zealand economy has been beaten up a lot more than others. But there's a lot of those companies that thought they were pretty good were probably not as good as what they thought. And there's been a lot of money destroyed in some areas.
Does that suggest there is what's the right word? A disconnect between, certainly what we need at an infrastructure level across many aspects, and basically the government's intent to basically run a budget surplus. They seem, don't they seem inherently pointing in opposite directions?
So there's a whole lot of enablers, areas we need to look at to address New Zealand's productivity story. And one of them is infrastructure. And there is growing tension here between what the strategy should be. Because the government strategy is very clearly, we're going to go through what's called austerity. All right, so more money coming in the door than what's going out the door, because we need to rebuild the fiscal buffer, get debt down, because we know statistically every 10 years we go through an economic shock that could cost us 10% of GDP in regard to debt. So in those periods where you don't have the shock, you've got to rebuild the buffer because we know something's coming down the track. And you want the government to be running tight fiscal policy because that helps get inflation down, and that allows Adrian to keep interest rates lower than what would otherwise be the case. You want to be fiscally responsible. So there's a whole lot of logical arguments as to why the government needs to tighten up, on top of the fact that we've had this era where money's been thrown around like confetti and it hasn't delivered an awful lot of results. So on some levels, they're doing the right thing. Now, the flip side is that what's the opportunity cost of not investing? And there are very obviously some areas where we're behind the eight ball and we've got a 10 to 20 year catch-up period. And maybe we just need to accept the higher levels of debt and put a little bit more fiscal discipline around what's going on. So my personal view is that the government should still run an austerity-based program, but not as intense as what they're promoting. You take a little bit more time to get back to surplus. Have a look at those opportunity costs of not investing in specific sectors, because that opportunity cost will be, a further push out in getting productivity up. And productivity is not the be all and the end all, but it's pretty bloody close.
Exactly. Is that a good segue into tariffs?
It is. Well, other countries appear to have better productivity than we do, which is frustrating. Overseas, there's quite a lot of talk, when you read the headlines particularly, and go beyond, about tariffs, about how that's pushing some economies around. And New Zealand, as you know, is sort of a cork on the ocean of the world. And how do you see the biggest push for tariffs playing out, and what does that mean for our relationship with trading partners? And what do you make, I guess, of the US's approach?
Right, put aside tariffs for now, and let's just have a look at what we've seen in the past 5 odd years. What we've seen in the past 5 years is a number of tectonic shifts. Now, tectonic shift number one is that the rules-based system we've been used to in regard to trade is now being usurped by countries exercising power. That's Ukraine, Russia, Middle East, China, Taiwan, and Donald Trump with what he did with Mexico and Canada. They're basically riding roughshod over the rules. And we're seeing that narrative in our everyday lives. Gangs that take over towns. Kids challenging the authority of teachers. So it's not just a trading theme, it's a theme within society. The second theme is that security is now very influential in regard to trade. And it's security in food, energy supply, and the big one is actually technology. And there's a big bun fight going on between China and the United States at the moment over semiconductors, because the chips control the computers and the computers control the machines. And the United States is trying to slow down China's advancement in regard to access to the latest technology. And the third bigger picture theme is just in time has now been replaced by just in case. Onshoring is replacing offshoring. We want to have that security of supply, control over where that equipment is coming from. And this is manifesting on a whole lot of various issues, and probably the biggest one for New Zealand is China versus the United States. Because we like to play in the Amazon world, we like to play in the Alibaba world. And you look at what's happening down with the Cook Islands. And New Zealand's obviously not happy with what's going on. What happens if Donald Trump makes a call and says, I'm not happy with what's going on with the Cook Islands? Do something about it. Because some parts of the South Pacific are strategically important. So the whole world is being turned on its head now in regard to Vangelis Vatakalis, who's New Zealand's chief trade negotiator, talks about the end of the golden era for trade. It's just going to get harder because protectionist barriers are going up. Now, New Zealand's probably a little bit fortunate because we're quite well liked, and we've probably been a little bit lax fully penetrating some big markets such as Japan because we've had other markets such as China. We've got to work pretty hard unlocking new markets, but I think going back to some of our existing markets and actually giving them a little bit more of a rip. It's been interesting to see the big transfer of red meat products away from China into the United States in the last 12 months. The United States is our biggest export market for red meat products. It used to be China, hands down.
What's triggered that?
Well, China's consumers no longer spending as much, and we redirect the product into the United States, and the US consumers still spending. But I think a lot of that has just been success, pretty good management by businesses recognising where they need to go.
So if you're a business owner, I mean, how would you tackle it? Suppose you're an exporter. What would be on your mind?
How do you incorporate geopolitical risk into your decision-making process? Because for a long time, we haven't had to worry about geopolitical or geostrategic risk. It's just send the stuff to the best paying market or where we can get the best volumes into the market, which has typically been China. There is now a huge strategic risk in regard to China. So the old adage, just be careful how many eggs you've got in the same basket, comes to mind. Diversify your export base. Make sure you've got those other markets that if something does take place, and we've seen this happen before, you have a look at the Australian viticulture industry. When they decided to sort of poke the bear and said a few words about China, China came back and they didn't hit iron ore, they didn't hit coal, they hit viticulture.
Are there any, emerging markets that New Zealand could be, or I guess markets that aren't emerging but we haven't really fully exploited that you think we should be focusing on?
Well, there's the entire southern part of Asia. You think about the growth in Indonesia, just the population, Malaysia, Vietnam's got a growing middle class income. The one we'd love to get into, but it's going to take a lot of work, is obviously India. Australia's still a bit of a march on us. So, it's going to take a lot of work. My question is, it's not just about new rapidly growing markets. Japan is still a top 4 economy around the globe. Right? And I think we're light on what we'll be doing in Japan. If you want to sit back and think about the next 30 to 40 years, where we're going to see a lot of growth, just go have a look at the population projections for Africa. Every continent tends to have a bit of a tectonic shift every couple of hundred years, and it looks like Africa's turn's going to come. We're light touch over there, but it's still a long way away. But they've got a very young, growing population, a little bit like Indonesia.
Yeah, okay. So how do you, one way of thinking about the US and Trump's behaviours is that he is, running roughshod over a rules-based system, using dominance and power to achieve their sort of geopolitical objectives. And he's indifferent with the sort of geopolitical conflict that follows from that. And then, which is, one lens. The other lens is that he's very business orientated. He wants certainty across trade flows that favour the states, and is trying to facilitate that happening. How do you see those two, lenses playing out? And I get, and one observation is, of course, is he put tariffs in during his last term, and then the Democrats never took them off. And so, there's a sort of a push and pull at play, which I think a lot of people are trying to make sense of.
Yeah, well, America's got some validation in regard to what they're doing. Right? Even if you look at some things such as, America's played the big peacemaker around the globe, and other countries, including us, and we do it the same for Australia, we don't exactly carry our weight in regard to defence spending as a share of GDP. So he's using trade-based policy to drive accountability or responsibility in other areas, so that the United States doesn't carry an unnecessary high portion of the cost, paying the likes of global policemen, this sort of stuff. So there is a bit of rationality about it, and he's a businessman, so he wants to cut a deal, and that's pretty hard for the established bureaucracy to get their head around, because the established bureaucracy is the established bureaucracy, where you take time, and two-way street in regard to what's going on. You have a look at what happened with Canada and Mexico. It was just like bang, and there was a deal in 48 hours.
And that seems to be one of the interesting takeaways, especially, the Mexicans were prepared for that. They had their response basically sorted. We're going to send troops to the border, and it got them a deal. We need to be thinking about that sort of, playbook.
Yeah, well, it's just the type of example. The Cook Islands, like Winston Peters expressed a lot of concern out of that deal, right? And Winston is very strategically alert in regard to what's going on. Now, if you go back and have a look at World War II and some of those islands that were strategically important through the South Pacific, you sort of start to understand why there might be some concerns over China's influence over the Cook Islands. Suddenly that becomes a bit of a base. And it's not just there, it's other parts of the South Pacific as well. And why at some stage the Americans might get on the phone and be a little bit stern in regard to what the expectations are. And New Zealand's defence spending as a share of GDP is around 1.2%. We're about half what we need to be. The issue is where does that money come from? Because if we pump it more into defence, there's less money available to put into health, education, and infrastructure roading. But we've run down defence capability for decades.
Yeah, it doesn't sit neatly with the austerity mindset that the government is obviously trying to push towards at the moment. Do you think that Australia's in the same position as we are? Different exports and so forth, bigger country, of course, but they're juggling this trade connection with China and their, at the same time, defence relationship with the States. How do you think they're going and managing that?
Well, it was interesting to hear Scott Morrison words, the highlights on the news when he spoke at the Waikato Business Forum. And the relationship between the United States and Australia is a lot stronger than what we've got with the United States. And they've been reaping the benefits of some of that, strategically. But Australia has been prepared to stand up to China more than what we have. Now, that has come at an economic cost in some situations, and the viticulture industry in Australia got belted for a period, but it's come back. But they've been a lot more vocal on certain issues where New Zealand is trying to play a little bit more of a Switzerland approach between the two. And the jury is out as to whether that Switzerland approach can continue. Particularly that Southeast, that Pacific stuff is worrying.
Okay, back home then, obviously immigration has been really strong and then it came off a bit. Where do you see that playing out for New Zealand? And does the brain drain concern you any more than it has in the past?
So you've got to have a look at the numbers because it amuses me. If you look at migration, it was up 130,000 in a 12-month period, which was just absolutely nuts. Right? If you go back and have a look at the historical average for migration, it's about 25,000 per year. We're still above average. Right? So it's not like we're not having people coming in the door. And when you get a very divided world up in the United States, I don't think there's going to be any shortage of Americans that want to come down and live in New Zealand. Suddenly we don't look too bad. There's a lot of chatter about brain drain. If you look at the data between New Zealand and Australia, there's actually no evidence that it's a brain drain. It's a little bit more of a brain exchange. That said, it is worrying when you see 55, 60,000 New Zealand citizens leave in a 12-month period. But you got 0.2% productivity growth. Your wages are not going to be going up too much. New Zealand's, there was a quote, I think, was it who gave the speech? Paul Conway from the Reserve Bank. The New Zealand's income used to be 95% of the OECD average. It's now 90%. We've got to close that gap. And you're not going to close that gap unless you've got productivity enhancing initiatives. And we're starting to see the right conversations. Ian Rennie, head of the New Zealand Treasury, was up at the Waikato Business Forum, and he gave some quite good insights in regard to overseas investment, foreign direct investment, and we're very light in that area, R&D, that sort of stuff. I was involved in a session on education. So we're starting to have the right conversations. There was a session there on energy. It was actually a really good forum and talking about lots of the right issues. But your talk only goes so far. You need to see action on the other side.
Just on that, I guess, is a question about how do you encourage the action on the other side, right? Because as Mark mentioned earlier, infrastructure generally is where we need more infrastructure. How we finance that is one of the big challenges. Where do you see that coming from, and how do they take action and actually deliver it rather than talk about it?
Different layers. Yeah. So if I have a look at, for instance, the roads of national significance, which is a big program. There's about a $6 billion hole in regard to how that's going to get paid for. Some of that will get paid for by debt, and some of it will be congestion charging, tolls, value capture taxes, that sort of stuff. But we are going to end up paying for the infrastructure on the other side. Local authorities have got the same problem, and local authorities have been turning increasingly towards rate increases. I think the local authority elections this year will send them a bit of a message. We're sick of rates going up by double-digit rates. Look at alternatives. And this is where you get into things such as PPPs. You get into things such as asset recycling, i.e. sell some assets and recycle the proceeds and invest in the critical stuff over here. And every local authority should have an investment committee that analyses their portfolio every year and determines value, and value is not just by economic value or financial value, it's through social usage. And an asset that's not being used should get ejected. So, not that I'm aware of. And that's a big problem we've got in New Zealand, is that we build stuff, then we mismanage it. So it's a capital productivity, that's the efficiency of buildings, plant machinery and equipment, all the infrastructure we've got around New Zealand. It's a negative number. We build roads and then we've got to reassemble because we don't do it right the first time. It's just absolutely nuts in regard to what goes on. And meanwhile, there's road cones all over the place. It's just, you shake in regard to where we sit. So we just need to think differently. It doesn't matter what you spend on infrastructure. If you do not manage the infrastructure well, it is going to cost you dough.
Yeah, and I guess if the infrastructure has value, there's often parties who will take it off your hands and manage it well. They might have to charge for it, but as you say, that lets you recycle the capital into other projects. It's something I've often wondered why we, as a country, we're so reluctant to make changes in that regard. And obviously, the gentailers are an example of it, but there's lots of others too where we could do more.
Yeah, well, I think that whole asset recycling story will be quite big around after the upcoming election. I don't think people want to put it on the table at this election, but you're going to need to recycle proceeds out of some assets to free up cash to invest in critical infrastructure on the other side. And we need to go through the balance sheets of local and central government and get the private sector a lot more involved on a lot of these things. And the private sector's going to want an appropriate return on that stuff. But the mismanagement of education and health assets has just been phenomenal.
I'm surprised we've managed to make it this far through and not talked about AI. I'm just going to touch on it very quickly because, it's obviously in addition to Trump and all of his activities, top of everyone's mind. How do you think about the productivity benefits of that technology, and does it accrue to every country or only the countries that spend inordinates on investing in it?
Okay, so let's put a bit of context around this. People are now comparing the 1920s with the 2020s because of the bad stuff we're seeing, i.e. global fragmentation. What we also saw in the 1920s was a step change from a thing called industrialisation. Now, the 2020s equivalent of industrialisation is basically tech and AI. So we've got the downside stuff, but we've also got this phenomenal thing that could make us literally explode. And this is where I used to say 1 + 1 = 2 now. So 1 + 1 = 11. Well, 1 + 1 + 1 now equals 111, not 3. Right? That is the light speed which this stuff is taking place. The OECD Economic Survey of New Zealand 2022 talked within that document about New Zealand management practices and our slow uptake of AI and technology, and about it being a big inhibitor to growth and going to the next sort of sphere that we need to in regard to driving productivity growth. You know, boards around New Zealand tended to be a lot more concerned about maintaining capital as opposed to taking risk and adding value. We tend to have a lot of risk strategies as opposed to really embracing a whole lot of change. And we've seen that within a whole lot of companies. The earnings suffering we've seen in the past 12 months basically tells us New Zealand firms have been slow to adapt. Right? And we need to quicken the pace of that. Now, that's just corporate level. I was just at the education, at the Waikato Business Forum, we're talking about education, and the question was asked about teachers bringing AI tech into the classroom. And I said, good luck, because the kids know more than the teachers. Right? There's no way the teachers can keep up with what's going on. We need a third-party provider that's going to come into the school classroom in New Zealand and revolutionise how we teach AI, technology, digitalisation, that sort of stuff. The teaching fraternity just sticks to the basic, the maths, the reading, the writing, that sort of stuff, making sure we've got that basic stuff. But we need to be outsourcing it and just thinking fundamentally differently about how we're embracing AI, because it is surging along at 200 miles an hour in the United States business and on business schools. We just don't have that same sort of call to change coming down here in New Zealand. And part of the reason is that New Zealand's a nice little lazy market where you don't have full competitive pressures. So you don't have that real drive to innovate.
And the benefit from it to New Zealand could be high if we got it right. Do you believe that's the case, or do you think it's more that...
Phenomenal, because you can import the stuff. Right? It's available. You've just got to embed it within your business practices. You got to embed it within the DNA of your organisation.
Yeah, and I guess if you don't, then there's a gap between. So there is, the call to change will happen. It's just a matter of time, I suppose. And like paying down your debt on some infrastructure, eventually it comes home, right?
Yeah, well, you have a look at one example is, and I should have named names, but you have a look at the Spark as a business of the past 5 to 10 years compared to what we saw the decade before out of Spark. The decade before, Spark was constantly innovating. They're at the forefront of the product mix they were putting out there in the market, and then they sort of backed off and they got into their steady state. And the steady state is not the state you want to be when you're that sort of a business.
Yeah, risk-taking, It requires a mindset that perhaps some boards don't have and others really do have.
Well, in that sense, we've seen it in New Zealand where, often not popular, but we've seen at different points in time risk takers, or maybe those have been pushed, Longy, Douglas, etc. Maybe Trump falls into that. Does that suggest it's an environment where we're probably more likely to see some of those outside or left of field, maybe politicians or business leaders come to the fore locally?
We're in an environment globally and locally where division is rampant. So if you have a look at the 2023 election result, the National Party and the Labour Party got 65% of the vote. That's a record low for those two political parties. So the periphery got 35. And what we're seeing globally is a move more to the far left, counterbalanced by the far right in the political spectrum. And we're seeing it in America, Canadian politics, the United Kingdom, France. It's across the board. The world is splintering, and the chief economist of the International Monetary Fund in a speech about 3 months ago talked about what's called dissatisfied populations. And when you've got dissatisfied populations, you've got a recipe for division. and divided countries, it makes it pretty hard to pull together a centralist policy prescription, which is sort of where you tend to see economic stability. When you drive a policy platform out to the far left or the far right, you can pretty well guarantee the next election you're going to reverse it. And that's the antithesis of certainty, which businesses need to be invested. Ironically, New Zealand's got division, but I think we're probably a bit better placed on that front than what I'm seeing in a whole lot of other countries around the globe.
That's actually a really good note to land on. Cameron, next time you join us on the call, hopefully we have overcome our geopolitical tensions. It's never going to happen, but perhaps we have, put in place a strategy for infrastructure. Perhaps interest rates coming down have driven forward retail and construction, and we're in a better place that way, and you're actually seeing growth and perhaps some productivity growth coming through. The primary industry continues to deliver as it has been more recently. So that'll be a nice place for us to talk about. We'll see if it actually plays out that way. But thank you for joining us today, and all the best for the rest of the week.
No, thank you, and thanks for having me.
Great.
Thanks, Cameron.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning, or any other matter. Past performance is not an indication of future returns.